Have you ever been lucky enough to receive a big chunk of money? Maybe an inheritance, a work bonus, or even a lottery win? It's exciting, right? But then comes the big question. What do you do with it? Today, we're diving into one of the biggest investing dilemmas. Should you throw it all into the market at once with a lump sum investment, or spread it out gradually using dollar cost averaging? It's like choosing between diving headfirst into a pool or going in slowly. Both get you into the water, but the experience is totally different. By the end of this video, you will understand the pros and cons of each strategy, see how they've performed historically, and get some tips on how to figure out which one might be the right for you. But before we get into the nitty-gritty, let's address the elephant in the room, the unpredictable nature of the market. Do you think it's going up or down? Honestly, no one knows for sure. And yet, this is what underpins the whole decision. If you believe the market is going to skyrocket, you definitely want to invest that lump sum as soon as possible. But if you think a crash is looming, dollar cost averaging is a safer bet. Now, the problem here is quite obvious. No one knows for sure what will happen next. I mean, at least I don't, and if I did, I would mortgage my kidneys and make $1 million tomorrow. So how do you decide? Let's break down both strategies and figure it out together. Alright, let's start with lump sum investing, often abbreviated as LSI. Imagine this. You've just received a lot of cash, perhaps an unexpected inheritance, a generous bonus, or maybe you finally sold that vintage collectible for a hefty profit. Now, with lump sum investing, you seize the day and plunge headfirst into the market. You take that entire chunk of cash and invest it all at once, no hesitation, no second thoughts. It's like stepping off a diving board straight into the pool. But why would anyone choose this seemingly all-or-nothing approach? Well, the allure of LSI lies in its potential for substantial returns. If the market happens to be on an upward trajectory, you're essentially buying at relatively the lowest price you'll be able to get. Every dollar you invest gets immediate exposure to potential growth, and the longer your money stays invested, the more time it has to compound and potentially multiply. The simplicity of LSI is another attractive aspect. It eliminates the guesswork of trying to time the market, which is a notoriously difficult task. With lump sum investing, you are not attempting to predict when the market will peak or dip. You simply invest and let the market's long-term trends work in your favor. This approach can be especially appealing for those who prefer a hands-off approach to investing or who don't have the time or expertise to monitor the market's fluctuations. However, as with any investment strategy, LSI isn't without its drawbacks. One significant risk is buying at a market high. Imagine pouring all your money into the market just before a downturn. Suddenly, the value of your investment plummets, and those dreams of rapid growth might feel like a distant memory, and you might spend years just getting back to zero. But worse than the mathematical drag on your portfolio, witnessing your investments decline in value can be a nerve-wracking experience. Even seasoned investors can feel the sting of anxiety when their portfolio takes a hit, especially if it's a sizable sum of money. This emotional toll can lead to impulsive decisions, such as selling at a loss to avoid further pain. So while lump sum investing offers the potential for higher returns and a straightforward approach, it's important to be aware of the risks and the potential emotional impact. It's a strategy best suited, in my opinion, for those with a high risk tolerance and the ability to weather market storms without making rash decisions. Now, let's shift gears and talk about dollar cost averaging, called DCA. If lump sum investing is like diving headfirst into the pool, then DCA is more like going in gradually, getting comfortable with the temperature and the surroundings as you go. With DCA, you don't invest your entire cash all at once. Instead, you divide it into smaller chunks and invest those chunks at regular intervals. This could be weekly, monthly, quarterly, or whatever schedule you choose. The key is to be consistent. This is very important. The moment you start thinking that the market will go down a bit more and you might wait another week to catch those lower prices, you're getting into market timing. And if you are good at that and investing in individual companies after doing a lot of analysis, then that's fine, I have nothing against it. But then probably you wouldn't be watching a video about dollar cost averaging in the first place, right? So by you being here, I assume you don't want to try to time the market, so don't do it. Set a schedule, mark it on your calendar, block out the noise, and when the time comes, invest it without hesitation. So, what's the appeal of DCA? Well, the primary benefit is risk reduction. By investing gradually, you're less likely to buy all your shares at a market peak. Instead, you're buying at different price points, which means you're averaging out your cost per share over time. This is especially valuable in volatile markets where prices can fluctuate significantly. DCA can also be a good strategy for those who are more risk averse or who experience anxiety about investing a large sum all at once. Spreading out your investments can make the process feel more manageable and less intimidating. It's like taking small, steady steps instead of one giant leap. Usually people would say that it helps minimize regret compared to lump sum investing, but honestly, I'm not so sure about that. If the market goes up significantly, then you'll regret not putting it all in 6 months ago, as you would have done with lump sum investing. But if you do lump sum investing and it goes down, then you'll regret not spreading it out. So again, a lot of other investors talk about the DCA strategy minimizing regret, but I think both of them have potential regret as an outcome, and it simply depends on the market direction, as I said in the beginning of the video. Now, just like any strategy, dollar cost averaging has its drawbacks. One downside is the potential for lower returns if the market consistently rises. As I said, if you had invested your entire lump sum at the beginning, you would have benefited from the full extent of the market's growth. With DCA, some of your money might be sitting on the sidelines while the market climbs. Another potential challenge with DCA, which is entirely psychological and up to you, is the need for discipline. To reap the benefits of this strategy, you need to stick to your schedule even when the market is turbulent. It can be tempting to pause your investments during a downturn because you think markets will drop more, but that's precisely when DCA can be most effective. So DCA might not be the most exciting strategy, but it can be a reliable and less stressful way to invest, especially for those who are new to the market or who have a lower risk tolerance. It's a slower and steadier approach that aims to balance risk and reward over the long term. Alright, let's now get down to the heart of the matter. Which strategy is better? Well, the answer isn't as simple as you might think. Historically, studies from reputable sources like Vanguard have shown that lump sum investing often outperforms dollar cost averaging over the long term. In this study, for example, Vanguard shows that lump sum outperforms DCA 68% of the time. This means that if you had invested a lump sum in the market, on average, you would have ended up with more money than if you had used DCA 2/3 of the time. Why is this the case? Well, it all boils down to the fact that markets tend to go up over time. By investing your money all at once, you're giving it more time to potentially grow and compound. With DCA, you're essentially holding back some of your money from the market, and that means it's missing out on potential gains. In this study, for example, it is shown that by missing just the 10 best market days in the last 25 years, you will significantly diminish your returns. Had you invested 100K in the S&P 500 25 years ago, they would have turned into 651,000. But if you missed the 10 best days, the investment drops to 298K. And as you can see from the picture, the more of those days you miss, the more your return drops. Now, you might be thinking, but wait, isn't DCA supposed to be safer? And you're right, DCA can offer some protection from buying at the market high. And as with all things investing, it is normal to expect lower returns if you want a safer strategy. In this study, you can see how if you can start investing in a falling market like in early 2022, with DCA, you will only lose 6%, whereas if you had put a lump sum of money, the loss would have been 18%. This is the case because you're creating a lower cost basis every time you buy and the market drops. This is something I can speak of from my experience because during the 2022 crash, I had a large amount of money from 2 failed real estate deals, and I was aggressively buying REITs, which are companies that own real estate. Instead of putting it all in during the beginning of the year, I spread my investments in even parts until the last months of 2022. Now, the reason I did that was because I saw that the Fed is raising rates and they stopped pumping money in the economy, and so I expected the market to fall more and to continue to fall through the year. So, was that market timing on my part? You could say so. Speaking of that, another crucial factor to consider is the concept of market timing. Both LSI and DSA avoid trying to time the market. However, as I mentioned already, you can get tempted to try to time it with both strategies. With the lump sum strategy, you can try to time when exactly to put your money in. And with the DCA, it's even worse because you will try to time it multiple times. I'm not saying that it can't be done, but it requires a lot of both fundamental and technical analysis and is a topic for another video. What I'm saying is that if you do it, then you are getting outside the idea that stands behind both methods. But let's be real. Investing isn't just about numbers and statistics. It's also about emotions. And here is where the psychological aspect of investing comes into play. For some people, the idea of investing a large sum of money all at once can be incredibly stressful. They might worry about buying at the wrong time or seeing their investment lose value. For these individuals, DCA can be a more comfortable and less anxiety-inducing approach. It's like the difference between jumping off a high dive and taking the stairs into the pool. Both get you into the water, but one is definitely more daunting than the other. And here comes the moment when no amount of statistical research can help you if you don't know yourself and the way you react in different situations. Because of that, there are also some nuances to the strategies in which we will get later. Before that though, let's see some hypothetical case studies. These examples will illustrate how the two strategies can play out in different market scenarios. Case study 1, the bull market. Meet Sarah, a young professional who received a $20,000 inheritance. Confident in the market's upward trajectory, she decides to go all in with a lump sum investment. She buys shares of a diversified index fund, putting all $20,000 into the market at once. Over the next 5 years, the market experiences a bull run averaging a 10% annual return. Sarah's initial investment grows significantly and she ends up with a portfolio worth well over $32,000. She is thrilled with the results and grateful she took the plunge with the LSI strategy. Now, let's rewind and imagine Sarah had chosen dollar cost averaging instead. She divides her $20,000 inheritance into 20 monthly installments of $1,000 each. Over the same 5-year period, she consistently invests $1,000 per month in the first 20 months, regardless of market fluctuations. While her portfolio is still going to experience growth, it doesn't reach the same heights as the LSI approach. Because she's investing gradually, she misses out on some of the early gains when the market was rising rapidly. Her final portfolio value is likely to be lower than if she had invested a lump sum. Case study 2, the bear market. Now, let's meet David, a retiree who received a $50,000 pension payout. Concerned about market volatility, he opts for dollar cost averaging. He decides to invest $2,500 every month for 20 months. Unfortunately, just as David begins his DCA plan, the market takes a nosedive. Over the next year and a half, there is a bear market with an average annual loss of 15%. However, David sticks to his schedule, investing $2,500 each month, regardless of the market's performance. By the time the bear market subsides, David has invested all $50,000. While his portfolio has experienced losses, he has also purchased shares at lower prices during the downturn. As the market recovers, his portfolio begins to rebound. Now, let's consider what might have happened if David had chosen lump sum investing. If he had invested all $50,000 at the beginning of the bear market, his portfolio would have suffered significantly bigger losses. The emotional impact of seeing his investment plummet could have been devastating. What is the lesson? These case studies illustrate the potential outcomes of both LSI and DCA in different market conditions. In a bull market, LSI often outperforms DCA, but in a bear market, DCA can help mitigate losses, reduce emotional distress, and improve the performance of the portfolio in the long term. So far, we've explored lump sum investing and dollar cost averaging as two distinct strategies. But as I said previously, what if there's a middle ground? A way to combine the best of both worlds? That's where hybrid strategies come into play. Think of a hybrid strategy as a custom-tailored suit perfectly fitted to your individual needs and preferences. It's not a one-size-fits-all approach, but rather a way to personalize your investment plan based on your risk tolerance, financial goals, and comfort level. One common hybrid approach is to invest a portion of your lump sum upfront and then dollar cost average the rest. This allows you to immediately put some of your money to work in the market while still spreading out the risk of buying at a high. It's like dipping your toes in the pool to test the water before jumping in completely. For example, let's say you have $50,000 to invest. You could choose to invest $25,000 upfront as a lump sum and then invest the remaining $25,000 in monthly installments of $1,000 over the next 25 months. This way, you're getting immediate exposure to the market with half your money, while the other half is gradually invested, potentially smoothing out the impact of market volatility. Another variation of a hybrid strategy is to adjust your DCA schedule based on market conditions, which will involve market timing, yes, but it allows you to take advantage of an obvious market trend. For instance, if the market is experiencing a downturn, and this is obvious, like it was for me back in 2022, you start with the DCA instead of the lump sum, like we did in the previous hybrid strategy. That way, you will take advantage of lower and lower prices. And then, when you see the market starting to recover, and you're convinced of that, without trying to time the exact bottom because you won't be able to, you put the rest of the money in a lump sum investment. This dynamic approach allows you to be more opportunistic with your investments while still maintaining the discipline of regular contributions. Hybrid strategies can also be a good option for those who are unsure about which path to take. It allows you to test the waters with both LSI and DCA and see which one feels more comfortable for you. You can start with a smaller lump sum investment of, let's say, a quarter of your money, and then gradually transition to a longer stretch DCA if you find that you can't sleep well even with that quarter invested as a lump sum. The beauty of hybrid strategies is that they're flexible and customizable. You can tailor them to fit your specific needs and risk profile. It's all about finding the right balance that works for you. Because remember, investing isn't a one-size-fits-all game. It's a personal journey that requires careful consideration of your financial goals, risk tolerance, and comfort level. So don't be afraid to get creative and experiment with different approaches. The key is to find a strategy that you're comfortable with and that you can stick with over the long term. Because after all, the best investment is the one that you can actually make, stick to, and not lose your sleep in the process. If you want more help with it, then I invite you to my free investing masterclass, for which you can find more info in the link in the description. All right, let's recap the key takeaways from our lump sum investing versus dollar cost averaging lesson. First and foremost, there is no one-size-fits-all answer to the question of which strategy is better. It's like asking whether a hammer or a screwdriver is the superior tool. Both have their uses, and the best choice depends on the specific task at hand. If a long bull market is ahead, lump sum works better. If a long bear market is ahead, then dollar cost averaging works better. That said, here are some key points to remember. First, lump sum investing historically outperforms dollar cost averaging over the long term in rising markets. This is because it offers immediate exposure to potential market gains. Second, it requires a higher risk tolerance and the ability to withstand short-term market fluctuations. Dollar cost averaging can help reduce the risk of buying at a market high and offers a more gradual and less intimidating approach to investing. However, it may result in lower returns if the market consistently rises. Hybrid strategies combine the benefits of both LSI and DSA. They offer flexibility and customization based on individual preferences and can be a good option for those who are unsure about which strategy to choose. So, what does this all mean for you? Here's some actionable advice. If you're investing for the long term and comfortable with risk, lump sum investing might be a suitable choice, especially if you believe the market is poised for growth. LSI can help you maximize your potential returns. If you are risk averse or investing a large sum of money, dollar cost averaging could offer peace of mind. DCA can help you smooth out the impact of market volatility and avoid the emotional distress of investing everything at once. Or you can consider a hybrid strategy if you want to balance risk and reward. This allows you to get some skin in the game immediately while also taking advantage of the benefits of DCA. Remember, the most important factor is to choose a strategy that you're comfortable with and that you can stick with through thick and thin. But in order to do that, you need to be educated. Because of that, after you have signed up for my masterclass from the link in the description, and while you wait for the event, you can check out this hour-and-a-half long investing guide I did. It shows you the main reasons and considerations when it comes to investing and goes through all the major asset classes and strategies. So click on it and I'll see you there.